As you may know, there has been a new subject circulating around the internet, and for present and future investors, this may be a concerning topic that should be discussed. On May 2nd, 2022, acclaimed billionaire Ray Dalio mentioned in his article, The Popping of the Bubble Stocks, an update, that the stock market is now on the verge of a bubble, which is comparable to the dot-com disaster and the Great Depression of 1929. He added that these bubbles may be classified into 6 measures that repeat themselves throughout the course of history, one of which is honestly disturbing and similar to what we are experiencing right now. This also comes at a time when the stock market is off to its worst start since 1939. The survey indicated that respondents are more skeptical about the stock market today than they were during the onset of the COVID-19 shutdown or in 2009. Now, you might be wondering, what does this popping of the bubble mean for us? Or how are we going to be affected by this dropping possibility in the market? And several questions more. But fear not, because we at InvestStops are here to educate you further. We will start by breaking down previous bubble cycles and compare it to our current market today. Afterwards, we will be sharing our own thoughts regarding this matter. But before that, please click the like button to help our channel bring more people into our little bubble. While you're at it, click the subscribe bell icon to this channel and stay on the loop with the latest videos on personal finance and investments. Before delving deeper, let us first learn more about who Ray Dalio is and why his opinion matters when it comes to topics about investments and stock markets. Ray Dalio is currently the co-chairman and co-chief investment officer of Bridgewater Associates, the world's largest hedge fund, which he founded in 1975. Bridgewater has grown to over $140 billion in assets under management throughout that time, frequently outperforming the S&P 500. And Ray Dalio has gathered over 45 years of macro investment knowledge during some of the market's biggest boom and bust cycles. Now, Ray Dalio believed that the world is currently in the middle of a bubble. Bubbles in the market are simply defined as a type of economic cycle marked by fast increases in market value, particularly in asset prices. To help people in identifying our times easily if we really are in a bubble, he gave 6 measures for us to observe. First, high pricing in comparison to standard value metrics. Second, situations that are unsustainable, such as projecting past revenue and profitability. Third, new naive buyers are becoming interested in buying in the market just for the sole reason that it is trending. Fourth, there is widespread optimism or broad bullish sentiment. Fifth, a significant portion of the market is being financed by debt. And lastly, a lot of forward and speculative purchases were made in the hopes that the price rises would continue. Indeed, some of the biggest investments on record businesses over the previous few years have been dependent on unsustainable past results. During the COVID-19 shutdown, new investors purchased at record numbers. Meanwhile, at the end of 2021, bullish sentiment reached an all-time high, and just 6 months ago, margin debt has reached a new record. And one could say that there was a lot of excitement for investing because stocks only go up. Now, apparently, there are several evidence that may prove Ray Dalio's idea that the market might truly be in a bubble and is most likely to collapse by the time you finally decide to make an investment. Back in January this year, he called out the inflated values of some companies. which later turned out to be accurate. He highlighted that the bubble indicator was approaching 70% of the peaks seen in 1929 and 2001, implying that some companies were excessively overvalued and on the verge of crashing under the proper circumstances. Or, I guess, wrong circumstances if they caused them to crash. Nonetheless, they were about to drop anyway. Fewer consumers entered the market. Investor sentiment was excessively optimistic, and IPOs were at their highest since 2001. However, since the first report came out, the stock market has evidently popped, and he was correct in calling them out. Furthermore, he emphasizes that bubbles can take a long time to unwind, and just because they aren't at a bubble extreme doesn't indicate they are safe or that now is a good time to go long. In reality, our metrics still show that US stocks are overvalued in general. As he predicts, once a bubble bursts, it will continue to fall, and in this case, most past bubbles have settled around 20%, giving us a little more leeway to fall. In fact, emerging technology has followed the same path as both 2001 and 1929. And the key question now is, how do we compare to the rest of the market with prices down ranging from 15 to 70%? Well, he has shown that the market is elevated but falling in comparison to previous bubbles. The price-to-earnings growth ratio is similarly high, but as fewer new investors enter the market, prices have begun to come down. Forward growth now signals that there may be more room to fall, but the biggest surprise is that bullish sentiment is at an all-time low. Now, here's why that last part is quite intriguing. Studies have shown that the more people feel that there will be an approaching crash, the more likely the market will do the exact opposite and not crash. After all, a recession normally begins after peak enthusiasm, not fear. And so, when consumer sentiment declines and bullish sentiment reaches an all-time low, it usually means, hey, you know what? This might be a fairly good time to purchase. Just take a look at the data from the last 60 years to see for yourself. Large drops in consumer sentiment result in an average SP 500 gain of 23% throughout the next 12 months. The US Crash Confidence Index is another thing to keep in mind as well, because it measures the investor's mood and sentiment, and how likely they believe a crash will emerge. Now, this is really crucial because the overwhelming evidence shows that the typical investor is nearly always wrong on the most critical points, and if the average investor feels prices are about to go much higher, that typically means that things are about to get a lot worse. The more scared investors are, the more likely we are to have bottomed out. And now that we've started to trend lower, this could be an indication that we're about to witness a reversal. On the other hand, this is reflected in the Warren Buffett Worry and Greed Index, which reveals that the current market is mostly driven by fear, particularly when the market trades considerably below its 125-day moving average. Although it appears like we are nearing a reversal, before we discuss what this means for all of us as investors and whether or not Ray Dalio is correct in believing that we are still in a bubble, let's talk about the well-known saying, sell in May and go away, to understand it further. The expression is said to have originated from an Old English saying, sell in May, when merchants and bankers in London's financial sector realized that their investment returns were lower in the summer. However, it is assumed that the stock market underperforms in the 6-month period between May and October in the modern era. Now you might be thinking, is there any actual evidence to prove if these instances do happen? And the answer is yes. It is true that between Memorial Day and Labor Day, investors are more likely to go on vacation and take time off, which means less activity in the market and downward pressure on prices. As a result, one chart shows that the average May return since 1928 has been negative 0.1%, but the May through October timeframe has returned an average of positive 0.3% since 1950, and the May return in 2021 will be 0.56%, up from 4.53% the year before. The other interesting point is that despite May's poor track record, the June to August period has historically been the second best of the year, with gains 63% of the time and an average return of 2.97%. And stocks have delivered positive returns over every 6-month period between May and October over the last 10 years. So, while May does not normally perform as well as the other months, it has done well in the past. Plus, let's face it, attempting to predict the market based on an old English saying is obviously a terrible idea. However, according to Ray Dalio's research, the market is regarded pricey based on historical indicators. But this is a good sign that people are starting to be negative because irrational exuberance is a much stronger indicator of a bubble than extreme pessimism. Of course, he also implies that the market has more room to fall, with the condition that what one does with it is a subjective decision. He goes on to argue that bubbles frequently overcorrect and sell off beyond what their fundamentals would predict, meaning that if things become bad, prices will get worse, which might be a great time to keep buying in. The housing market, on the other hand, is a whole other scenario. Just as most Americans are negative on the stock market, a new poll finds that only 30% of Americans say this is a good time to purchase a house, the lowest level since the survey began in 1978, and the first time that less than 50% of individuals across the country believe this. As a result of the negative appraisal, more people may be kept out of the market, resulting in slower sales, an increase in inventory, and consequently lower housing values. Another is the ongoing issue of home affordability, which is currently at an all-time low, with rates having risen an additional 50 basis points, the largest increase since 2000. If housing prices remained unchanged, we could hit a new low for housing affordability any day now, with the average monthly payment having increased 72% since the pandemic began. The problem today is that a lot of individuals are rushing into the markets to get ahead of rising mortgage rates, believing that if they don't buy now, rates will continue to go up. We're also seeing a lock-in effect in which homeowners refuse to move because doing so would mean giving up a historically low interest rate. Of course, if we follow the same logic, if the average investor is often always wrong and believes it is a horrible time to buy, then perhaps it is. Okay, but jokes aside, getting back into the real estate market today may be a great idea because there are finally numerous deals being offered by sellers who want to sell or pay out quickly. Furthermore, even during price fluctuations, rentals tend to be rather constant over time. If you're planning on becoming a long-term investor, well then, having a continuous cash flow is much more appealing. But honestly speaking, it's not really shocking to witness if higher rates cause some softening in the markets, and some sections of the country could see a lot more inventory in the next few years. However, due to a shortage of new development and great demand, it's not surprising as well if prices stayed very high, at least until the regulations were modified to allow for additional construction and establishment. And so, to answer the dilemma behind the reason why the market is about to drop, it appears that Ray Dalio was correct in identifying some market areas that were significantly overvalued and have since fallen significantly. If you are all in SPAC, IPOs, or rising tech during stay-at-home plays. You probably lost a lot of money if you didn't sell. However, determining whether or not the overall market is overvalued is much more difficult. And just because data suggests that it is substantially relative to previous history doesn't mean it can't go any higher. As for us, we believe that the best solution for this is to simply diversify as much as possible across many different industries, whether it's stocks, real estate, cash, or even a small amount of cryptocurrencies. Then, just accept that prices will change for no apparent reason in ways that make no sense and are utterly beyond your control. Long-term experience has proven that markets eventually return, prices trend rise again once more, and for now, the most profitable thing you can do, if you haven't already, is subscribing to our channel. Once again, please click the bell icon to get notified when more videos on personal finance and investments go up. If you learned something from this video, go ahead and give us a thumbs up. Thank you for watching, and we'll see you again in the next video.